Hi, this is Supriyo. Today we are going to cover everything about ATMs. We are going to cover the promissory notes, the bills of exchange, the checks, and everything about the statutory acts that are important for our bank exams. So let's begin with the types of ATMs. So the ATM, what is the ATM? So it is the automated teller machine. All the transactions that we are doing in the banks, most of them we can go ahead and do in the ATMs. And of course you must have used the ATMs. So we use something called the PIN or the personal identification number. So using the PIN, we can actually access our cash if we want to draw cash, or we can also do a host of other activities at any ATM. So the ATM, it is a place where we can do financial or non-financial transactions without the need of visiting the branch. So that's the important thing that you need to remember. This is important. The first ATM in India, it was actually launched by HSBC Bank in Mumbai in 1987. And if they ask you what was the first ATM machine in the world, it was actually set up by Barclays Bank in London in 1967. So 20 years before it started out here in India. And sometimes you can get asked about various different types. So what was the first floating ATM in India? It was actually set up by the State Bank of India in Kochi, Kerala. And there was also a lot of news about the first ATM that came up at Leh, which was primarily to help our Indian Army. And that was also set up by SBI 16,000 feet above sea level. Now the three main types of the ATM. So remember that RBI is giving license to all these people. So without an RBI license, you cannot manage an ATM in India. Now the main three types. So the first one is the traditional bank ATM. Now we have all been to these. So there are three different types of these. So first one is the on-site ATM. So on-site ATM means the ATM which is actually attached just next to a branch. So in a branch, you might have seen some ATM just alongside it. So that is actually the on-site ATM. Off-site ATMs are those which are actually a little bit farther away from the branch. So it may be a few kilometers away from any branch. So those are called the off-site ATMs. And there is also a third type, which is the worksite ATM. So worksite ATMs are those ATMs which are situated inside a workplace of a certain company or any big organization. So only the employees of that organization or that company can go ahead and mostly use those worksite ATMs. So these are the three types of the traditional bank ATM. Then we have what is called a brown label ATM. So what is this brown label ATM thing? Now brown label ATM, it is actually mainly created because we wanted to reduce the cost of operating an ATM machine. There are some companies which are actually owning these ATMs, but the logo is going to be of the sponsor bank, and the cash management also is going to be done by a sponsor bank. So those are called brown label ATMs. And there are also some other types. So let's just take a look at the other types of ATMs. Now all these types of ATMs we have in India. So there are green label ATMs. These are exclusively for agricultural transactions. Orange label ATMs for share market transactions. Yellow label ATMs for the e-commerce transactions. Pink label ATMs, from the name itself you can understand, these are only for women, and actually they are manned by guards which do not let the men to enter, so only women can use. Biometric ATMs are there. These are the ATMs which uses fingerprints, or they use eye scanners for the transaction authorizations. Then you have the micro ATM. Now micro ATM is very important for your financial inclusion because these are used by the business correspondents, and they are used to deliver basic services to small villages, small towns, etc. So they are very useful in financial inclusion. Then you have the mobile ATM. This is also used for financial inclusion. These are ATMs on wheels. So on a bus or a van, they are going to just go from town to town and disperse cash and do all the financial activities. So these are also helpful in financial inclusion. So that's all about the other types of the ATMs. Then you have another type which is the white label ATM or the WLA. Now these ATMs are actually operated and owned by non-banks. So NBFCs are totally responsible for these kinds of WLAs or the white label ATMs. Now the RBI authorizes these NBFCs via the Payments and Settlement Systems Act 2007 to actually own and operate these ATMs. And remember that the first such type of NBFC to operate this white label ATM, it was IndiCash, and now IndiCash, which is owned by Tata Communications, is the largest white label ATM ATM operator in India, and you also have other NBFCs like Muthoot ATMs you might have seen. So these kinds of ATMs are called white label ATMs. So that's all about the types of ATMs, and now we have something called the on us and the off us transaction. So what is an on us transaction? On us means that whenever you as a customer of the bank go to a same bank's ATM and make some transactions, that is called on us. And off us means that you, for example, you are a SBI customer and you go to HDFC Bank ATM and you are actually making some transactions. So that is the off us transaction for SBI. So let's take a look at the differences between these two types and the free transactions that are allowed. So for an on us transaction, when it is the same bank, then a minimum of 5 free transactions you can get per month. So remember that non-cash transactions must all be free, but if you are doing any kind of financial transaction, then minimum of 5 have to be offered by your bank free. And if it is a off-us transaction and it is done in the metros, then minimum 3 free per month you are entitled to, and the metros are Bengaluru, Chennai, Hyderabad, Kolkata, Mumbai and New Delhi. So remember that if it is in a non-metro, then you have to have minimum 5 free per month. So remember all of these things, and also remember that the maximum amount of transaction fees that they can charge per transaction is 20 rupees plus any taxes. So whatever taxes are there, they are just exclusive of that. And also remember that if you have any failed transactions, so anytime that you go to a ATM and your cash is not actually disbursed but your account is debited, any kind of these things, it has to be resolved within 5 days. If it is not resolved within 5 days, for each additional day they have to pay you 100 rupees. So this is very important. If they are not resolving this within 5 days, then 100 rupees per customer per day the bank has to pay. And the next thing is the NFS. So what is the NFS? It is the National Financial Switch. Now it is very important. So NFS is actually India's largest ATM network, and it was developed by NPCI, the National Payments Corporation of India. And also remember that the IDRBT was the institute that actually created this NFS system. And what does this do? So any kind of transactions that happen in different banks, different bank ATMs, how does that money get routed? So if you are actually transacting in an HDFC Bank ATM but you are actually an SBI customer, so how does that money actually flow between the banks? That is done by this NFS system. So they ensure that the Indian ATM network is actually flawlessly operating between all the different member banks. So remember that. And now let us move to the next part. So this is the promissory note, bill of exchange and the check. So the first thing that I want to do is actually explain the slight differences. So a promissory note, this actually has two parties. They are the maker and the payee. So what happens, this is basically an IOU. So we have already talked a little bit about the promissory notes in our previous videos. It is just a simple agreement, a written promise whereby you are telling a person that I owe you this much of money and I am going to pay you. So that is the main concept of a promissory note. And what is the main concept of a bill of exchange? Now this is actually used mainly within companies. So just think about it that I have actually requested some kind of an item from you. So you are a seller and I am a buyer. Now I get that material from you, but I tell you that right now I do not have the money to actually pay you. So I will be giving you some piece of paper and telling you that later on when I get the money, I will be making the payment. So that is a bill of exchange. So the bill of exchange actually allows you to get the payment from me. And remember that this bill of exchange you can actually endorse or you can negotiate. So this means that you can just transfer the bill to a different person, and in that way there are three people who are involved: the drawer, the drawee and the payee. And in the similar way, a check also has three parties, and a check of course we have all used. So we are using that check to effect a payment to some other person via a bank. So these two things, let us just see in detail about what the differences are. So when we compare a bill of exchange and a check, we can see what these three things mean. So drawer, drawee and payee. In a bill of exchange, who is the drawer of the bill? It is the seller of the service. So remember our example, I was the buyer, right? And you are the seller. So I have to give the money to you you are the person who is actually going to draw this bill of exchange. So the seller is the drawer in a bill of exchange. Remember that these things are very, very important. The check, what happens in a check? The one who is paying, that person is the drawer of the check. So if I have to make some kind of a payment, then I will be the drawer of the check. So that's very important. And what about the drawee? So in a bill of exchange, the drawee is the buyer or the person who is actually paying. So in our example, I was the buyer, right? So I will be paying you. So I am the drawee of the bill of exchange. And remember that a bill of exchange, it actually has to be stamped. So when we actually get into an agreement in a bill of exchange, we are actually just going to be accepting the bill of exchange, and after that we are going to stamp it. So there is a revenue stamp that we must affix on it so that the government comes to know about this contract, and that is the drawee. And for a check, the drawee is the bank. So the bank on which we are actually drawing this check becomes the drawee. And what about the payee? So understand this thing, in a bill of exchange there is a seller and there is a buyer, right? Now when the seller actually needs immediate money and the buyer cannot pay him, what will the seller do at that point of time? The seller can actually negotiate or transfer the ownership of this bill of exchange to a third party. So in some cases the payee can be the seller or the drawer. So the drawer can be the payee in certain cases, but if the seller, as I told you, just transfer this bill to a third party so that the seller gets some kind of a money immediately, then the payee can be a different person. So the payee is the person who gets paid. So just understand this, that there is a piece of paper, right? The buyer told the seller that I will be giving you. So this is the piece of paper. Now it will take a long time till the buyer can actually pay the seller, right? So the seller goes to a bank and then this bill, the bill of exchange, is discounted. So what does discounting mean? This bill is actually sold by the seller to the bank at a discount. So the bank takes some commission, and after that discount the bank becomes the payee, because now what will happen? Now the buyer is not going to give the money to the seller. Now the buyer is going to give the money directly to the bank. So the one who gets paid, in this case the bank, becomes the payee. So that is the payee in case of a bill of exchange, and in a check the one who gets paid, that is the payee. So if I am writing the name of somebody on a check, the person who is going to get the money, that is the person who is going to get paid, and that is all about the different types of drawer, drawee and payee. So you understand now the differences between all of these things. And as we talked about, what is the endorsement of a negotiable instrument? This means usually it actually means that on that piece of paper that you have, on the reverse you are signing your name and you are telling another person is owning that now. So you are just transferring the ownership to another person. So that is what we call endorsement of a negotiable instrument. So now what is the promissory note? It is a written promise, as we just discussed, from an issuer to the payee, and this is actually an unconditional document. So unconditional payment will be made in a promissory note. And of course we have discussed this also, that promissory note has two types. So there is the demand promissory note, which means that whenever the money is demanded, you must go ahead and you can pay it. So remember that demand promissory notes are actually not allowed in India. In India only the RBI and the central government can go ahead and issue or accept these demand promissory notes. So we usually do not use that. We use what is called the usance promissory note. So usance promissory note means that there is some time frame, some time period after which you can make the payment. So you get some time to actually pay back the money whenever it is called for. So that is called the usance promissory note. So that is the main difference. And then we have the bill of exchange and the check, and also something called a demand draft, a DD. Now a demand draft is actually something which is said to be the safest kind of negotiable instrument, because demand draft can never be dishonored. So that's a very important thing. Let's just see the difference. So these are the three important instruments. So there is a check, the demand draft and the bills of exchange. Now what are these instruments? So these are negotiable instruments, all three of them. The parties involved, we just discussed about the check. The check has three parties, the drawer, drawee and payee. Same thing goes for the bill of exchange as well. And the demand draft, it has two parties. So you have the drawer and you have the payee. So the drawer of the DD is the person who creates it, and the payee is the person who is going to get the money. Next is the payment. So a check is payable either to order or bearer. So payable to order means that only the person who is named will be able to get the payment. So that is payment to order. And by bearer means that anybody who is holding that check can get the payment. So that is what bearer check means. And these are the two ways in which you can get the payment done. For the demand draft, it is always payable to order. Now this is very important. This is the reason why a demand draft is one of the safest things. Apart from the thing that it cannot be dishonored, now it has always got to be paid by order. So this means that the person who is named on that demand draft will always get the money. So any other person cannot get the money. And the bills of exchange, they are payable on demand or usance. So we have already discussed these things. And what is the differences in the issued by? So the drawer, so a check, the individual who is the bank's customer is actually drawing the check. So the individual is the drawer. In the demand draft, the bank itself is issuing it. So remember, this is very important. So the bank guarantees that the funds are going to be transferred to that person. So it's very, very safe. And the bills of exchange, the creditor who is entitled to receive money, that person is the drawer. We already discussed that. And what about the bank charges? So in a check, there is no charge. In a demand draft, yes, we have to give some bank charges. And in a bills of exchange, we have to give the charges only when the bill is discounted. Now I explained to you about the bill discounting. If you have any kinds of difficulties in understanding, let me know in the comments. I'll definitely help you out. And always remember that the charges in the form of stamping are always there in a bill of exchange. So stamp duty you have to actually pay. And can I dishonor a check? Yes, of course. I can say that I do not have funds, and there can be many different ways by which the check can be dishonored, but a demand draft can never be dishonored, as we talked. So it is the safest instrument. And the bills of exchange, yes, of course, it can be dishonored as well when the person who is actually the buyer says that I cannot pay you, I do not have the money. So in that way it can be dishonored. And also remember another thing, that a check, it is actually valid for a maximum of 3 months. So 3 months is the validity in a check, and after 3 months you cannot encash a check. It becomes a stale check. So we are going to take a look at that. And a demand draft also has a validity for 3 months. Now remember this, a demand draft never expires. This is very important concept to understand. So it remains valid for 3 months, and after that also you can go to the bank and you can revalidate that demand draft. It never expires. So that's a very big difference. And the bills of exchange, there are nothing like that. So it depends from bill to bill about their validity and how long they are applicable for. So that is the main difference between these three things. And now coming to the different types of check crossings. So this is also very important. Let's take a look. So first you have to understand what crossing actually means. So crossing means whenever in a check you have two parallel lines. So two parallel lines like this, if you are actually drawing, then it is called a crossing on a check. Now there is something called a general crossing. General crossing means that you are using something like and company or account payee or non-negotiable. Like this, if you are doing, it is governed under section 123 of the Negotiable Instruments Act. And this general crossing, this actually just makes the check a little bit more safe. So you can only get the payment under these conditions. So this and company, this and CO you might have seen in some checks. So what happens there? This means that the person who is named on the check, along with that the company that is named, they can also get the payment. So that is the and co. Then you have the account payee checks. So this means that only the account of the payee can be credited with that money. So it's very important that the check can only be deposited into the account. So you cannot get the cash over the counter. And the non-negotiable, it means that you cannot negotiate this instrument any further. So these are the general crossings. Then you have the special or the restrictive crossings, which are governed under section 124 of the NI Act. Now this means that only a specific branch or a specific bank can be mentioned over there and you can get the payment. So in these parallel lines, if you have something written like State Bank of India, so this means that only in State Bank of India account you can go ahead and put the money. So it is the special kind of a crossing. Then you have the dishonor of the check. Now this is a criminal offense as per section 138 of the Negotiable Instruments Act. And remember this important thing, very recently the Ministry of Finance has said that we are actually trying to decriminalize this kind of an activity. So they are trying to decriminalize this because they do not want to clog up the courts with these criminal cases. So that's why they are trying to do it now. And then you have the open checks. So as I told you, these are the checks that are payable at the counter and they are uncrossed checks. Remember this, no type of crossing is there. They are called open checks. You can just deposit at the counter and you can get the money. And then you have the bearer check. So this is a check that can be paid to the bearer. So the person who is holding that check can get the money. But remember, 50,000 is the limit. Above that, you cannot get money using this kind of a bearer check. Then you have the order check. So it is only payable to the person named. So as we already discussed, it is payable to order. And the cross check, so drawing parallel lines on the check as we just discussed. And there is also a stale check. So I told you that 3 months is the maximum validity of a check. So if you are not withdrawing your money in 3 months, then this check becomes a stale check. So it's very important, remember that. Then you have a mutilated check. So any check that is torn into 2 or more pieces and it is altered and you cannot make out the details. So those kinds of checks are called mutilated checks. Then you have the post dated check. Now this is also very important. Post dated check means that the date of the check is in the future. So if you are issuing that check on October 1st, but you just wrote down over there October 10th, then that check cannot be encashed before October 10. It's in the future. So any kind of loans, whenever you are taking, usually banks will be taking some post dated checks or PDCs, they say, just to ensure that you can make the payments and it is some kind of a security. Then you have the antedated check. So this is the same thing, just the opposite thing. The date is in the past. So if on 1st October you are actually writing that it is for say September 29, 2020, then it is an antedated check. And then you have the cancel check. Now cancel check is also very important. Just a normal check on that, on 2 parallel lines. Between that you are just writing over here cancelled. So in block letters you are actually going to write CANCELLED. So that is the cancel check, and they are actually sometimes used for verifying your identities. And when you are getting the job in the bank, some banks are going to ask you for it. And then you have something called the check truncation system. It was actually started in 2010. So details are not that important for our exams. Just remember that it will allow for faster clearing and it uses the MICR code or the magnetic ink character recognition code, which is a code of 9 digits. Now we are going to take a look at the different kinds of codes in a later video. So we are going to discuss that. Just remember that CTS systems, CTS checks are now used because they are very fast in clearing. So that's all about the various categorizations. Then you have the difference between the demand draft and the banker's check. So it's very simple. Demand draft is when one person is giving another person money, and a banker's check means that a bank is giving another person money. This kind of check draws the money from the bank's funds. So any kind of payments if the bank has to make to you, usually a BC is issued, a banker's check, and the manager has to sign on it and you can get the money. So that's the main difference. And another question that is sometimes asked in interviews is the currency note a negotiable instrument? Your answer will be no. It is not a negotiable instrument. It is something that you can say a bearer bond, a non-interest bearing bearer bond. So that's what a currency note is. Now let's go to the statutory acts. So the important acts that you need to remember. The first one is the Negotiable Instruments Act of 1881. Let's see the important provisions. So it's a very important act. Remember that all the bank holidays that are declared by the center or state government or the union territory are declared under the NI Act. It has 142 sections and important sections. Let's take a look. So section 13(1), it actually defines a negotiable instrument, which means a promissory note, a bill of exchange or check payable either to order or bearer. Then the important sections, and these are very, very important. Section 4, it defines promissory note. Section 5 defines bill of exchange. Section 6 defines a check, and section 15, it is the definition of endorsement. Section 85A, this actually defines your demand drafts. So just the things that I have highlighted, just remember those things and that will be enough about the Negotiable Instrument Act. Let's move to the next act, which is the Banking Regulation Act. So this act was passed in 1949, and just note that very recently after the PMC bank crisis, it was amended in 2020 and all the cooperative banks were brought under the RBI's supervision by this act. So it's very important because of this, remember it. And all the important kinds of sections, so we have already discussed it in our first video. I hope that you remember it, and I don't know how many of you are actually watching the videos from the first video. If you are, then thank you so much. And so section 5b, it defines banking. Section 5c, it defines a banking company. Then section 7, it defines that no other company can use bank or banker or banking, these words. Section 8, it says that bank cannot buy or sell or barter goods except bills of exchange. So it basically prohibits the bank from getting into trading business. Section 9 says that a bank cannot hold immovable property beyond 7 years. Section 24, now this is very, very important. This is about the maintenance of the SLR or the statutory liquidity ratio. We already talked about it. Also section 56 has some provisions of the SLR, but mostly it is section 24. Section 45 has recently become very important because the powers of reconstruction or amalgamation to RBI have been given in this section, and they were actually recently just modified a little bit by the amendment that we had for the Banking Regulation Act. So remember this thing as well. So that's all about the Banking Regulation Act. Let's move to the Reserve Bank of India Act of 1934. So the RBI was set up under this act. It extends to the whole of India, and all these scheduled banks are named in the second schedule of the RBI Act. Just remember that the section 2E, under that they are all written, and those who are not included, they are called the non-scheduled banks. Now some important sections. Section 17, it defines how RBI can conduct business. 18, it deals with emergency loans to banks. Now another very important section, section 22 of the RBI Act, it says that RBI has exclusive rights to issue currency notes in India. Now this is sometimes asked in questions, so remember that. Section 24, it says that the maximum denomination of a note is 10,000 rupees, what we already discussed. Section 26 describes that Indian bank notes are legal tender. So legal tender definition is there. Section 31 says that only RBI or Government of India can accept a demand promissory note. So what we already discussed, I just told you about it, but this is the exact section. So if anybody asks, section 31 is the reason why the demand promissory notes the public cannot deal with. And of course the very important section, section 42(1), which defines the CRR or the cash reserve ratio. So maintenance of CRR is very important. And also section 42 defines the NDTL of the banks as well. So these two things are defined under the section 42. So that's all about the RBI Act. And then coming to the FEMA or the Foreign Exchange Management Act 1999. Now this is also a very important act because it empowers RBI to promote and regulate cross-border trade and payments and forex management. Now it had actually replaced the Foreign Exchange Regulation Act of 1973, remember that, and it paved the way for the Prevention of Money Laundering Act of 2002. And another important thing is that the LRS or the Liberalized Remittance Scheme of the RBI is governed under this act, and the current limit for that is $250,000. Now we are going to discuss about this later on in a later video. Just remember that the remittance limit is $250,000 in a financial year. Now the section 4, it actually governs the holding of foreign exchange. Section 5, it governs current account transactions. Section 6 governs capital account transactions, and these two different types of accounts we are going to discuss, so don't worry about it. Section 7, it governs export of goods and services. And also note that RBI manages the foreign exchange reserves under the RBI Act 1934 and not under the FEMA Act. Some people have a confusion regarding this, and remember that the RBI's forex reserves recently, it actually crossed above $500 billion for the first time. So that's also something that's very important. So that's all about the Foreign Exchange Management Act of 1999. Now the rest of the acts, it's not that very important. Just remember some of them, like the Banking Companies Acquisition and Transfer of Undertakings Act 1970. So this was the act under which we had all the bank nationalizations. So we have already talked about it in 1969 and 1980 what happened. So I hope that you remember it. And then you have the DICGC Act of 1961, the Deposit Insurance Credit Guarantee Corporation Act. So in this act, the DICGC is actually set up and defined, and now the limit for that is 5 lakh rupees per bank. And so remember that as well. Then you have the Companies Act of 2013. All companies are governed under this, so remember the foundation of that act. And the RDDBFI Act, or the Recovery of debts due to Banks and Financial Institutions Act of 1993. We also discussed this. It's the act responsible for the debt recovery tribunals or the debt recovery appellate tribunals. So that's all about the different types of acts. I hope that you learned something from this video and that it was beneficial to you. If you enjoyed it, please leave a like and share it with your friends. And if you want to see more of this kind of content, please click on the subscribe button and do not forget to click the bell icon so that you, my friend, do not miss any future update. I'll see you in the next video. Bye bye.